Hello, listeners. Welcome back to the podcast and to the Future of X series. If you've been following us for some time, you will know that Future of X goes deep into new and emerging tech territories with the aim of sharing the knowledge with all of us. In these episodes, we discuss advancements and innovations that are underway in fast evolving sectors and verticals. Today, we have with us Varun, co founder and CEO of the general insurance platform Acko, and we will be discussing with him something critical to the future of life and work in India: insurance. Varun has extensive experience in the insurance industry spanning over a decade. This is what he knows best, and it shows in how well Acko is doing. Before Acko, he was CEO and co founder of Coverfox, among other things. What's special about Acko is its simplicity, and this is by design. Acko is looking to disrupt the insurance industry and make it more transparent and offer hassle free access to policies, something that is critical in a country like ours, and where insurance is still accessible only to a certain populace. But what's next for Acko as it scales? And what's next for this industry? We learn from today's terrific episode. Joining us on this episode are Abhinav Chaturvedi and Subrato Mitra, my partners at Axel. Both have worked closely with Acko from inception and were the first to champion this particular problem and Acko's vision to solve it. Their views on this sector and why they think Varun is a special entrepreneur are also great questions I want to get into today. Let's dive in. Welcome back to the Seed to Scale podcast, Varun, Abhinav, and Subrito, all
Thank you.
repeat guests. So super happy to have you back.
Super exciting to be here.
Awesome. Cool. So I'm going to start out with you, Varun. So for the few who don't know what Acko is, I recommend everyone to try it out. But please tell us a little bit about Acko and the current scale of Acko.
Cool. So Acko is about five years old now. We are a general insurance company, or in some places known as a PNC company. We underwrite our own products, create our own products. From a scale perspective, we've got about now close to 60 million customers who we've insured across different products. Um, Probably this year we are at a close to about a 250 to 300 million revenue run rate. Largest business for us is auto insurance. We are a large direct to consumer, and probably the only direct to consumer auto insurance company. Apart from that, our second line of business is lots of contextual products across travel, gadgets, loans, and recently we forayed into the next big bastion, which is health insurance. So that's what we've been doing for the last 5 years.
Got it. I've used multiple of the products. It's awesome. So, Varun, when we last did the podcast 2018, you were running Coverfox and now Acko. So, walk us through what has happened in the last 4 years of the Acko journey.
So Coverfox was sort of the foundational ground for me also to understand whether that we really needed to control product pricing, claims, and Coverfox was a distribution model, a marketplace model, and over a period of time there was a realization that it's these are the long-term products. Customers stick with you for years. It's a trust business, and we really need to deliver far better experiences to customers, pricing to customers to be able to really deliver value. And that was the start of the underwriting journey, that we need to underwrite our own products with Acko. I think the biggest 3-4 things which have been learnings for us, or pivotal moments, or let me call it highlights over the last 3-4 years. One was our realization that we need to, given the fact that it's a trust business, people will trust an ICICI or Tata, Bajaj. We've all grown up with these names, but for a new company, for customers to come and park their money is hard. It's actually reverse of lending. Lending is easy. You'll take money from whoever gives you cheap money.
Yeah.
But on the insurance side, it's reverse. So I think one of the biggest learnings was that we need to start with price and convenience categories. But we'd love to insure customers for their health, life, auto, their phones, all of it. You can't start with complex categories, but you need to ladder up on the trust quotient. So I think price and convenience categories were auto, gadgets, travel, where the customer is okay to give you a shot, as a new brand. I think that those really went into the design principles of the business, that we will do auto, we will do some contextual products for customers where the transaction velocity is higher. I think that was one big learning. Second, within auto, I think the biggest highlight, which is our largest business today, was that really you don't think of insurance as a hyper local business. But with auto, we realized it is some sort of a localized business. It took us almost, I would say, 2 years to understand that when you want to underwrite customers, and you need to have enough geographical local knowledge, which are the theft prone pockets, where do accidents happen, when cars need to be repaired, you need supply chain efficiencies on repairing cars for cheaper, so you need density of customers in a certain geography. I think over a period of time, auto became like a local business for us, that we need to win city by city. I think that was a pivotal moment for us, really, for the business to start taking shape in the way that we desired. Third, I would highlight COVID. For a risk business, COVID is, and when you've got to pay out claims, I think biggest learning was that we always knew that we were in a risk business, but I think there was no better awakening that COVID could have. We had some insurance companies in India launch COVID products, and business was down. COVID products were selling. Auto insurance, no one was buying, and there was a huge temptation to launch products, which could shore up revenue, scale up revenue. We refrained from underwriting COVID insurance policies because our balance sheet would be exposed. It was a huge temptation at that point, and I think that was a critical moment for the team and for all of us to understand that in a balance sheet business, it's about risk-adjusted growth, not just some top line. I think that's become a motto for the company, that you always need to have risk-adjusted growth. And probably the last thing I'd like to point out is that we've really developed into a solid team. I think the company, the leadership that's come together over the last few years. Practically, I had only 20%, 10% value now. I think the ship runs with a lot of support and a lot of maturity from leaders. I think these are 4-5 big things that have happened in the last 4 years.
Got it. That's super helpful. So, with that context, let's come to the topic of today, the future of insurance tech. I want to bring in Abhinav and Subrito into the conversation now. So, Subrito, Abhinav, you've been on this journey right from the beginning, right? So, from Coverfox into Acko, and you've seen the insurance sector in India evolve. So, maybe talk about what are some of the things that have changed in the last how many years? Yeah.
So maybe I'll start and then Abhinav, you fill in because you're closer to the action. For me, when we went to Coverfox, I think we had already done a bunch of these e-commerce kind of companies, and on fintech I had done Scriptbox. So I'd looked at both distribution models as well as Scriptbox. I would call it more as a brand. So I found that building a brand is significantly harder in India. So my bias was maybe towards build distribution first, with products that are relatively easy to understand and which is kind of required across the spectrum. And then as you figure out which of these sub products are really differentiated and niche, you go create brands there. So I probably was trying to put that same image into insurance. And that's why it was very intriguing when we found Coverfox, and actually Prashant and I, we were working at it initially. Abhinav got rolled in, and that's why I thought that that'll be a great place to start. Simple product, which is high potential distribution. So that's how we got into Coverfox. But specifically talking about insurance as a sector, we have seen in the last 20 years how we used to buy car insurance. Some offline agent would walk in and try to tell you what's the difference between one type of car insurance versus the other, and I would be scratching my head as to why the hell is one actually different from the other. But I guess that's why this thin layer of kind of comparison shopping equivalent came in, where you could look at multiple different products and you could quickly pick, and then the backend integration that these guys created, so you could buy that product online very quickly and simply. So as we started working with Varun, I think we always used to look at what other models so we could relate to a Geico, and then in China some of these models started taking off, and then Varun came and told us that if you have very identified groups, he could actually, and the important thing is it's obviously a category that is very closely monitored by IRDA. So you can't have the flexibility to create new products that easily. So one of the things I learned from Varun early on is if you have a identified group, you could actually do very specialized kind of products for them. And then as we figured out, ran Coverfox for a while, one of the things we figured out is it's probably better to be vertically integrated in this category as opposed to do the distribution for multiple set of reasons, which is where I guess Varun decided to kind of create Acko. And I think we were very lucky that we were already in Coverfox, so it was sort of a natural progression for us. Maybe Abhinav, you want to add anything?
Yeah, no, I think on similar lines, the insurance industry in India hasn't really been, seen real innovation in the last 20, 30 years. And you should add more. Typically, the way insurance companies work, and these are largely bank-led insurance companies, they have a distribution channel across banks, offline agents, and some of them sell online. And they are largely driven by the distribution agent they sell to. And so the underwriting is very very archaic, and it's not very relevant for the consumer who they sell the product to. And so very little innovation has happened in the last 20, 30 years. And there was some little incremental innovation which Shubhra talked about, which is making it easier to buy these products, which is largely through online aggregators. And I distinctly remember talking to Varun about it, where I think people know about it, but it's very difficult to sort of zoom out and come up with a plan saying that, hey, I'm going to build an insurance company. Because at that point in time when we are speaking, this is 2016,
Yeah,
2017,
2016.
20,
Yeah.
like it was unimaginable to even think of starting an insurance company for a variety of reasons. One, you'll need a lot of capital, maybe like close to 40, $50 million to start with at that point in time as seed stage capital to start a business. Um, to get a license, there was no precedent of a license which was given by IRDA to a venture-backed company. We already had a going concern in Coverfox, so there was a company which was running, which could have been a reasonable size outcome. Um, but I think there was something lurking beneath, and that was Varun, which is saying, there needs to be more fundamental innovation in the industry. Otherwise, we are not really solving a problem. And that was the genesis of sort of how Acko came into being.
Yeah, yeah. I think one of the, it's such a simple thought process, but I think it takes time to learn and figure it out. Is when you look at, savings and wealth, or when you look at lending, or when you look at, insurance, and we all have a distribution manufacturing kind of lens to, whether I'm an NBFC or I'm just a loan aggregator. I think the difference in insurance is that you are not looking for portfolio. One mutual fund cannot manufacture every kind of investment need that you may have. You may want to invest in fixed deposits. It's a portfolio a game. But for insurance, really, I need as a consumer one reliable company. That's it. I'm not flipping, flopping, optimizing. I just need one reliable company where I can park and they don't trouble me at the point of claims and the product works for me. So I'm really not looking to shop. I'm looking for reliability and permanence, because really nobody wants to keep shopping insurance. And therefore, that to me was the moment that I don't need 10 insurers. I need one, one compared to I might need 20 mutual funds to, sort of work my portfolio, make it work for me. Therefore, building that one reliable, trustworthy brand, because you need one health insurance in your life. You need one life insurance. You don't need 20. So that shopping behavior is okay to solve the thin layer, like Shubhrata said. But if you can be that reliable entity for a certain segment of customers, that's it. Then it's 20, 30-year annuity revenues. That's how we look at it.
Got it. And this is a first approach, right? So that requires a change in consumer behavior. How do you see that happening? How is the speed of change, and is it changing fast enough?
Um, so tech first approach really helps you sort of solve some fundamental pieces of value that you can deliver to consumers. So for example, intermediation costs or distribution costs in the offline world are very, very high. To give you a sense, to buy a health insurance in India, you would insurance companies would pay 40% of the first year premium as commission, and then 25% forever on the same policy. Similar on auto, slightly lesser, but similar. That fat intermediation layer you can solve with digital distribution, either going direct or having different access points to customers, and that really cheapens the delivery cost to the user. Second part being the underwriting piece, where the ownership of the data and the relationship with the customer is with the intermediary, and to maintain his edge in the business, his or her edge in the business, they don't pass on information to insurance companies. So you are working with very limited data points as much as the intermediary is willing to give. Beyond
What kind of data are we talking about?
so for auto, like auto, I can give you lots of examples. In auto in India, I wouldn't take names, but the top five insurance companies in terms of size and scale have 20% phone numbers for their customers. Like I'm not even talking any sophisticated, and the reasons are simple. It's just that the agent or the car dealer or whoever is selling you the policy wants the ability to flip you, maximize commissions if he hands over your contact information or your details to the insurance company, then they can develop a direct relationship, cross sell something to that guy. So he loses that customer's wallet, and therefore they just don't pass on any information. Once you don't have information, you can't take calls on who's a good customer versus a bad customer in an underwriting business. So it almost becomes the industry has become um underwriting a distributor's portfolio
Yeah.
rather than underwriting the customer. So you're a large distributor for me. By and large, if you're giving me something which is not loss making, I will accept good risk and bad risk because at a portfolio level, it's kind of working. You don't get to cherry pick risk. You get to manage distribution portfolios, and broadly you play with commissions to ensure that you are able to just slightly get better portfolio. So there's no customer underwriting that necessarily happens. So direct access to customers with a digital distribution model. So all of this in my head is interlinked. So if you don't have direct access to customers, you won't get the data. If you won't get the data, you don't become a better underwriter. If you don't, the customers don't contact you at the point of claims. Today, if you have a small accident, most people in India go to the car dealer, give him the insurance papers, and say, you figure it out. Then you have lost any chance of optimizing claims cost because the customer is not even contacting you to fulfill the repair job. So unless you solve this through and through, you're not able to deliver value. So technology actually plays a part across the value chain, and the entire business model needs to work in cohesion. Um, just having an online distribution model just doesn't help. I think the next foray of innovation, apart from solving these basic customer ownership issues, is really customers starting to look at insurance as more than bill payers at the point of mishap. I'll pay your bill. Give you an example. Life insurance, nobody provides estate planning services with life insurance. You should. Can I provide you a service pack to insure to service your car along with your insurance, and AMC for your car. Unless the, customer starts seeing more value from the insurer, you'll always, you have very little interaction points with the customer. You renew and you claim, uh, and these are either annual or once in 5 year. So they continue to look at you as somebody who's going to pay the bill. That is probably what Acko will work towards, and globally also we feel that this is where the industry will go. That you will really have to provide services aligned to the category, and take the customer along with you.
If you take a category like auto, what are those kind of services? What can you provide?
Oh, we've just started that actually. That now we have about close to about 2.5 million vehicles insured with us, about 1 million plus cars, 1.5 million bikes. Now we know enough about these users, whether the car is hypothecated, it's on loan, what's the accident history of this vehicle, are you the first owner, are you the second owner? Our stickiness for customers is fairly high, so the customers are there with you for 3-4 years, right? Now we are now able to predict uh, that are you likely to sell your car? With your behavior, the age of the car, and so, or sometimes even asking innocuous questions on the product journeys to saying, hey, your car is 7 years old. Are you likely to, switch cars? Or now we started to move into providing exchange propositions, to customers. We tied up with the IDFC Bank and did fast tag for our, customers. Now we're launching you could buy an AMC plus warranty for your car apart from the insurance just during the insurance journey. So I think this is where wallet expansion will happen, stickiness of customers will happen. Auto, we've reached a size and scale where we can now start this ancillary product journeys, which make the customer stickier and expand the wallet. And customer sees far more value from the insurer than saying that if you have an accident, okay, I'll come to you.
Got it. And if you look at, and it's a question I want all of you to answer. So if you look at competition at traditional players, why can't they do all this, right? So from a layman's perspective.
I think what the biggest reason is, and I mentioned this, like they don't own the relationship with the user.
Mm.
The relationship is with the dealer or the bank or the agent. So what unfortunately has become about the with the insurance industry in India, you're like a wholesale balance sheet. You create some products which appeal to distributors in terms of commission structures that are inbuilt into the product, and really your consumer is the distributor. Because you want the distributor's mind share, wallet share, and the minute you don't have access to the end user, a lot of things you can't do. So, for example, IRDA is now opening up to value-added services, saying insurance companies can have value-added services. They don't really only need to sell risk products. Like banks can sell you mutual funds or give you a shopping voucher or airline points. Insurance companies are not allowed to have all of these ancillary businesses. Now they are opening that up. But if you don't have access to the end user, he's not talking to you.
Mm.
If you have any problem, you're going to call the agent. Then there's nothing much you can do.
Got
So
it.
unless a model changes where you have ownership of relationship, I think it'll be hard to pull it off.
In the US, this has happened, right? With Geico, Progressive, and all these guys, they've gone direct also more, or we haven't
Yeah,
seen that.
yeah, they've probably Geico and Progressive are probably holy grail in
Yeah.
terms of
Yeah.
how they've built it out. They also sell other products. They don't insure now.
Mm.
They because they're the distribution franchise built within the underwriting franchise, right? So today, if they don't want to offer life insurance, but they have as a balance sheet, they sell other people's products, and customers trust them. Just the ownership of the customer.
So you build the trust, you build the
Yeah.
direct relationship, then you can cross sell other insurance as well as value.
Yeah.
Anything to add?
Yeah, I think the US, I mean, where we are today, I would call it like more insurance 2.0 in India, which is very similar to, Geico and Progressive movement in the US. Um, we're building these direct pipes to the consumer, figuring out what they need, trying to price the product to their risks. Also building the underlying infrastructure to make sure that the claims are processed fast and there is a offline network, garages, etc., to process all that thing. So I think it's more like that. In the US markets now, like if you compare it to today, the newer players have become very, very different. I mean, they have gone to a level where they're trying to figure out a way that uh, you can price the product basis driver's ability to drive the car and so on, which hasn't really worked out so far. So the 3.0 model in the US hasn't really, I mean, you can see the stock prices, etc., of a bunch of these players. That hasn't really worked out. I think India is a little far from there. And the US market is different in the sense that, uh, it's a market which is large but slow growing, very high competitive intensity.
Yeah.
For the new age players there, it was very, very difficult to acquire customers from the existing large incumbents. And so they spent a lot of money on CAC, and they couldn't retain these customers for a long period of time because they found a better price in Geico and so on. Uh, that's not the case in India. India is a fast growing market. The private share of the market is growing faster than the public share of the market. So if the overall insurance industry is growing at 15%, the private market is growing at 25%. And there is no real direct to consumer
Yeah.
player in the Indian market. What do you think?
There's nothing there, nothing in India in terms of going direct to consumer, and direct to consumer is model is really a choice in a big way. Even in the US, Geico Progressive, who do direct to consumer, do not have an intermediated strategy. Or even if there is some intermediaries involved, it's like 10% of their business or 15% of the business. On the other side, you have somebody like Allstate, which is fairly large, which is like the ICICI Lombard of India, or they're very large. So companies have not been able to traverse both models in the same company. Channel conflict comes up, complications start to happen. So you have to make like a binary choice, because the intermediation layer is fairly strong, and the model economics are such, because the intermediation layers are so fat that Geico, to give you a sense, is probably one of the largest advertisers in the world, not just in insurance. It's probably they do one Super Bowl release every year. Their budgets compete with Coke, and that's how much they own the category. Therefore, for any new age player to come, it's very hard at that level of, you are the category. If you want to buy auto insurance in the US, you will check a Geico Progressive quote, and unless they give you a bad quote, you're not going to the new age startup to find something, right? That's not the case in India. To give you a reference point, Acko at its current size and scale, the direct to consumer advertising budgets that we operate with is larger than the entire general insurance industry in India. All the 20 other insurance companies put together. The reason is all the marketing costs go to intermediation. There's no margin left to advertise or to go direct. And
For the traditional
for
players.
just you're paying margins in the product are small, so you've already paid out 25, 30, 40% commission, so there's just no room to spend, and you start becoming the category. And a very interesting point is that when you start becoming the category, like in a couple of our older cities, Hyderabad and Bangalore, I would say we are the category, maybe not pan India. These are the first two cities that scaled for us. A reference point is that 50% of all car owners in Hyderabad that exist physically, new cars, old cars, have taken a quote from Acko, half the population. Now, what tends to happen is you get the first dibs at good risk versus bad risk. They're okay to buy from you. You give them a bad price, you weed it out. So you form the virtuous cycle. So the next guy who comes in gets the leftover bad risk. That's where Geico and Progressive have reached. So it's very hard to compete, not only to compete with their CAC, but you get the leftover substandard, not so good, riskier cohort. So that virtuous cycle, once if you are the first mover or the first few movers, you get that advantage, because now the next guy who tries to build a direct model will need to compete with trying to build a newer brand, and in the interim is going to get all the worse customers.
So in the US, you have the driver score and on all that, and you can weed out. You're saying Geico will get the first guy. He'll say, this guy is not that great. Let me not say no to him, but give him a high price so that he goes to the next guy. How do you do such a thing in India? Like, how do you figure that out?
I think India is, relatively data starved compared to the level of data that is available. Our data pipes have become far stronger. We know a lot more about our consumers. We've been able to find, surrogate underwriting to a large level. We know iPhone users will have different claim behavior than Android phone users, and we found fairly significant correlations in how customers behave. But yes, it's not as sophisticated as it's in the US. But pricing our customer out is something that we also do. But there is a curve. If you could be 20% higher and 10-15% higher and maybe accept that risk, but if you think you need to charge 30% higher, you actually should not be doing that business at all. Because even if the customer is willing to pay that 30 to 40% higher price compared to maybe he has other options in the market, then that's most likely to be fraudulent.
That's what we learned.
That's what we learned. That you could say, okay, it's risk. I'll price it. I'll price the risk, but you price it 100% higher. The guy still buys it from you. That means
Something's
he's
wrong.
find a way to get a claim out from you. So there's a curve. So we've learned over a period of time to say no, no, and just operate in cohorts that we are confident of, or at least we are reasonably confident of.
Got it.
Just to add to that, I think
Yeah.
the big change in like Acko versus the rest is, I think the change in model, which is going direct to consumer, getting all the information. There's a journey in terms of getting consumer data to price that risk better. But right now, I think the biggest delta which is caused, is going direct to consumer and be able to underwrite that, which is very hard for the other players to do that in the market.
Because of the agent-led model.
Because they sell to a different person. They don't sell
Yeah.
to the consumer. They sell to a distributor.
Got it. Okay. How about other new age players and all that?
So far, we've seen a lot of new players coming in, but largely in the distribution game. We've seen one or two new guys who came alongside us and had better technology, better models. But again, they have somehow, for reasons best known, resorted to the intermediation model, because it's highly predictable in terms of scale. You build your distribution broker relationships. There's a certain commission range you operate with. It's fairly predictable, business to get. So far we haven't seen anybody as a manufacturer go direct to consumer at all. We've seen some guys on the distribution side, but frankly, without being dismissive of any of them, we've lived that cycle to know that, yeah, somebody has to really do some really differentiated job to make a distribution, model work. And on that front, Policy Bazaar has taken the pole. Even now, Policy Bazaar has challenges of growth and, and some of the profitability, even after being a public company. So I'm not quite convinced on, personally not quite convinced on the distribution models. Manufacturing of the product, I don't think anyone's taken a direct approach.
And I'm just to add to that, so it's not a panacea that you build a direct to consumer manufacturing company and everything will be hunky dory. So there is a lot of risk which comes with it, right? So you are spending a lot of money upfront in terms of marketing dollars and acquiring a pool of customers that can be risky. So first, one needs to underwrite these customers well. In the early days, the company is small, so you need to write this risk really, really well. Second, it has an offline component to it, which is network garages, etc. So you have to build out a supply of these garages and make sure the customer experience at the time of claim is correct. And finally, the retention of these cohorts, right, needs to be maintained, and all these small things add up. And thankfully, I think over the last 5 years, we have worked on each of these things incrementally to make sure that each of these things are tight. And very very nice to say that now I think Acko's retention would be best in the industry today.
So our retention is this is very stark. So our retention is about 75%. So we retain about 75% of the customers.
And
customers.
what's the
Industry retention is about 45%.
Okay.
So the delta is and the reason is that the broker or the dealer in the middle is flipping customers out for higher commission. We don't have that problem.
Okay, they get a better commission
with somebody else, and so the way distributors do this is they have a relationship with you. They'll tell you, Abhinav, ABC company आजकल time पे claim नहीं दे रहा है, आप यहाँ से लो. Like, okay, I'll take it from there. But essentially, he has a commission, contest going on, double commission for this month or whatever, and you're flipped. So not having that relationship really has a huge play on your economics.
Got it.
Yeah.
Any other learnings from we talked about US, maybe China, or any other global learnings that on how this insurance industry is?
I think this is one thing which we discussed on monoline versus multi-line.
Yeah. I think one of the things is that in a risk business, and I think globally also you need to have very strong balance sheets, and you need to weather some of these risks, because you will have underwriting losses. It's impossible not to have losses on, every year, 1 or 2 cities for us bleed in auto, in spite of getting the metrics right. There are heavy rains in Chennai, cause of flood. We'll pay out crores in claims in that 20 days when thousands of cars are, submerged or now not working or whatever it is. You will have natural calamities. Now you can't expect to make a profit, in that year, in that cohort, or make any. In fact, you'll probably wipe out 2 years worth of gains in that one natural catastrophe. COVID, you will, companies lost a lot of money, and that's the nature of the game, that there will be these, black swan events. And now with climate change and all this happening far more frequently. So you have to understand that having probably a portfolio of risks is better, because something or the other will not work and drag you that particular year, or not being a monoline insurer. So if there are constant floods happening in cities, you will continue to bleed money. If you are only an health insurer, in India we have standalone health insurance companies who do only health. They took a very large hit during COVID, because there is nothing else subsidizing those losses, and you can't get away from these black swan events. So I think one of the other approaches, coincidentally, partly by chance, partly as we've evolved and understood our business better, is to constantly have a portfolio view of risks. That okay, if auto, we have to absorb some losses. We have health. If health, we have to absorb some losses. We have gadgets and travel, and not all of it will go down at the same
But
same
maybe
point.
the other thing is how does data help us figure out fraud, right? So
Yeah.
one is this distribution of the risk,
Yeah.
but the other big thing that you're open to is how does fraud affect?
Yeah, so we're way better. Have we figured out fraud completely? The answer is no.
No, of course.
Sometimes we bake it in the price because the long tail is too hard to solve. We figured out not fraud, but we figured out people who uh, uh, it's not even fraud. In Delhi, for example, it's a highly theft prone, Ghaziabad, Faridabad, you have the border UP, Bihar, and there's lots
But
of.
that's an opportunity actually. That's
So
not.
so
Yeah.
we've been able to now pinpoint and
Yes.
cluster even a place like Ghaziabad into safe pockets and not safe pockets. So the customer might be great,
Mm.
and everything checks out, safe driver, all of it. But unfortunately, he lives in one of those Faridabad row houses where parking is outside. It's huge risk because then the car gets stolen. So I think just getting sharper and sharper with data. I think it's getting better for us, and that's a really long-term advantage because you can't build this overnight. It'll come with years and years of learning.
Got it. So two aspects I want to touch upon quickly. One is it's a highly regulated industry, so any learnings from that or any changes needed on that. That's one. And the second we'll come to in a bit is on the capital intensity. We touched upon it.
No, I think highly regulated area, and maybe we'll talk about it. But somebody like Varun can manage, the difficulties and complications that come along with it. Early on, I think the hardest thing was to get a license. I think over time, until actually recently, FDI requirement was only 49. It was capped at 49%. So one had to struggle to find the domestic capital. It's been eased to 74%, so it's become easier. I think there have been some talks about reducing the solvency capital, which is the amount of capital you just need to have parked in the balance sheet to cover the risk in case there is a risky proposition going forward. So that money is not being utilized to run the business. It's just like sort of it's like a fixed deposit of sorts. So that if it was X, it is required to be now less than X. There's been talks about that. So you want to talk about that?
Yeah, so I think I think for any regulated business, or at least in our world, what we is having tremendous patience to continue to work with the regulator, because sometimes they have a very different worldview. Right, wrong, nobody to judge, because when they look at the problem, and we've had very frank conversations with the regulator that, hey, this is common sense, please allow this, or this is good for the customer, or blah blah blah. But they're always thinking of that last slightly uneducated customer who may get impacted and how this could get misused, because that's their job. So you even on capital structures or anything, they're always thinking of what could go down versus what could go right. So it's been a very patient journey to continue to educate, to continue to work with them, to continue to build your reputation with them, so that when they take you more and more, your suggestions or your thought process more and more seriously. I think one thing as Acko we are proud of, and we've done well, is we've maintained very, very high governance bars, and ensured that with the regulator we've never come across as trigger happy or reckless in any way. That now over 5-6 years has given us a seat at the table where we're looked at as the innovator, a responsible innovator, not just a new age kid on the block who wants to yeah. So I think that takes time, that takes tremendous amount of patience, that takes a leadership who's capable of, apart from just me building a team which can represent at the regulator's office. I think this has been good for us, good in some sense. Like Subroto said, it's a huge moat. Today we're looking at life insurance or expansion. We have a reasonable sort of welcoming regulator, given our history. So I think that's been pretty critical. And the what Abhinav was saying, the regime is easing out. They want more penetration to happen. They want more growth to happen. So they're reducing capital adequacy ratios, which will make us more, which will require us lesser capital.
Okay, now to you, Abhinav and Subrata, maybe we'll start with you. Can you share one aspect of Varun's journey, from building a business that new founders, the next gen of founders can learn from?
It's actually built into his business, his ability to take risk.
Okay.
So, but you look at it between when we started, which is probably 10 years ago, and now, we have actually had to kind of reconfigure the business in all kinds of different ways.
Coverfox to Acko.
Coverfox to Acko, and within Acko, the different streams that have now come up. So it's always been a constant kind of learning, and it's probably true for any company that creates an enduring business in India. You have to have this staying power and grit, and all of that is completely personified in Varun. But I think also importantly, more importantly, one of the things that he kind of does very well is to kind of not get carried away by either highs or lows. So to be level-headed and be able to deal with issues, especially in a regulated sector, and given the number of investors that he has on his cap table, so it actually required a lot of very fine management of a lot of different aspects of company building. So I think he's done it phenomenally well, and will continue to do so over the next coming years.
Okay, awesome. Abhinav,
Yeah, no, I think so. For last 8 years now, 2014 onwards. So
2014,
it's been 8 years, and so my son is 9 years old. So almost almost.
that's how you keep
Yeah,
track.
yeah. The first time I spoke to Varun, I had Ane in my lap, and while speaking. Yeah, I think if there's one thing which stands out for Varun is just ability to make things happen when it looked almost impossible for anybody else. And I can recount maybe like 2, 3 crucible moments in the journey of. Let's talk about Acko for now.
Sure.
When we were applying for this license, it was, I mentioned this earlier as well. It was very hard to believe that somebody could actually be able to raise this kind of capital as a seed stage money, and this wasn't very common in those days in India. To be able to work with the regulator to get the license out, to work with the domestic capital providers to get that capital also, it's very, very difficult. 51%. Yeah, because there was 51% requirement at that point in time of domestic cap table. Very, very difficult. In fact, sometimes, I had this conversation with Varun that why would you choose such a difficult thing to do? I mean, there are other easier things to raise capital for. And even very recently, our last capital financing, and perhaps the only one of the most person who was most agitated was me, and Varun was absolutely cool. I mean, it took us 9 months to get nod from the regulator for various reasons. And while I was calling him frantically every other day, and he was like, "It'll happen. Don't worry, it'll happen." And he and I was not doing much, and he was actually going to the regulator, talking to them every other week, and understanding their requirements and solving those requirements. So it was just sort of making things happen when absolutely it looked very, very difficult, right? And also, I mean, the 9 months, it wasn't just that the regulator, it was also the new investors coming and making sure they are up to date about it. And there was a time when he set up a call when there were all investors in the call, and this was basically all the internal investors, also the incoming investors, and the round hasn't been done yet, and he was absolutely honest about where we are in the situation, and he asked for our opinion and our advice. And it was very nice to have the external folks also chip in, saying that we can also help you get this through. So it was just building that trust in the relationship with these investors while things look seemingly very, very difficult.
Got it. That's great.
Huh?
Yeah, it's always better to sleep well.
Some of the lines I can.
So not just my problem.
Make
Everyone's
it
problem.
every. That's
Yeah.
good, man. That's awesome. Maybe the last question to you is, where do you see Acko going? You talked a lot about auto, but we haven't touched upon your other businesses and also the future plans. Maybe whatever you want to talk about.
I think over a period of time, our ambition has become, we're able to sort of articulate our ambition far more clearly, which is that there is like we define it now internally, that phase one for Acko, I don't know whether it takes 2 more years or 5 more years, is really trying to own the protection wallet of a retail consumer, So you've got auto, you've got health, you've got life insurance, maybe to some shape and form, home insurance that may be possible in India, and then you've got all your, sporadic transactional needs. You're traveling, you need travel insurance. You're buying an expensive gadget, you need warranty or whatever. All of this put together, it's sort of your protection, wallet, and we want to own that wallet for a certain segment of users as much as possible. We have now enough confidence to say that when customers come to our website and say, "Hey, why don't you have health?" Some of customers have emailed and told us that we're waiting for you to, launch, because that's the level of credibility, the ease, the transparency that we've been able to build. Just with one product, focusing for 4 5 years, and doing that. So I think the next phase for Acko, or the next 5 years, look like ensuring that now that we have a customer franchise, we built out some sort of a brand. Of course, it needs to grow and scale. Is really starting to complete that wallet. Health can be a company in itself. Life can be a company in itself. So we are working towards ensuring we're true to the category. We deep solve the category, but at a horizontal level, we start owning more and more of that wallet. So what you'll see from Acko is probably a foray into one new category deeply every year to try and complete that wallet. This year is all about health. Hopefully next year will be all about life.
Got it.
Yeah.
Cool. On that
Yeah.
note, thank you so much for coming and sharing the journey on Acko, and wish you and the company the very best. Thanks, Abhinav Subrata, for sharing
you.
your perspective as well.
Thank
Really
you.
appreciate
Thank
it.
you.
Thank you.
Thank you.
Okay. That was an awesome conversation, which I thoroughly enjoyed and learnt a lot from. I hope you did too. All the best to Varun and his team as they build the future of insurance tech in India. Thanks to you for listening, and please do tweet us at Axel_India. We'd love to hear from you. Please subscribe to our podcast if you haven't already. Our website is seedtoscale.com/insights, where you can find other such episodes from our series. That's all from us today. Stay safe. Thanks again for listening, and goodbye.